To you both for being here. Nancy, you know, obviously the inflation panic has morphed to some degree into a full-on growth scare. I mean, obviously consumer cyclicals getting hit pretty hard. People concerned about exactly what we might be looking at in terms of potential recession. Does that seem well grounded to you? Does it explain how the market's acting?
Well, yes, I think it does explain it, Mike, and thanks so much for having me. I mean, you and I have had this conversation for the last year that we were going to slow in 2022. I mean, that is just the math. We knew this. But I think what you're seeing now is this extrapolation of recent data out to infinity. So we have a negative GDP print, which was driven largely by an increase, a dramatic increase in imports as we unclogged the ports. And that had a negative effect on GDP of 3.2%. If that were backed out, you would have seen a 1.8% rise in GDP. But underneath the numbers as well, you saw a strong consumer, and you saw consumer saving to the tune of 1.2 trillion. And that was against 1.39, I think, in the fourth quarter when transfer payments were still in place. So the historical data is not as bad as is being stated. And I hear people sort of say with impunity, oh, we had negative GDP in the first quarter. But there was a lot of good that was going on underneath, including an earnings season with real companies that was pretty darn good, as witnessed by them raising their dividends. So I'm happy to use this as an opportunity to step in and buy the higher quality names for the next 3 to 5 years.
Sandy, you focus on dividend stocks, equity income fund mainly, and they've held up rather well. In fact, better than other companies that, you know, more focus on buybacks. Do you expect that this type of environment, which is going to foster outperformance of dividend stocks, is going to continue? What are you finding in terms of, I guess, what you have to pay for some of the favored names?
Yeah, so we've been running an equity income fund for 25 years. My team has run the same strategy for that long, so we have a lot of experience in this area. These stocks were as cheap as they were back in the late 1990s, early 2000s, during the tech wreck that happened back then. We were at the same position at the beginning of this year. They were very, very cheap. And so I think that because they were cheap to begin with, and they've got growing dividends because free cash flow is growing and they are cheap, you have all those things combining together to set them up to be very good investments during this more inflationary period where the growth is a little less certain, and you know that you're going to get a good return, a dividend return plus the free cash flow growth.
Are there areas, Sandy, that you're finding, you know, stocks come into your zone in terms of valuation or dividend yield or anything else just because of the market volatility?
Absolutely. So we have done a couple of things. I mean, we run our screens every week looking for companies that have sold off where all of a sudden a high quality name like, say, a Home Depot, for example, which had traded down at its heights below 2% dividend yield, all of a sudden has a dividend yield that's closer to 2.5%. That's very interesting to us. We also have taken advantage of the volatility and written puts against many high quality names where we not only get the premium from the put, but we are able to, if we have the stock put to us, acquire the stock with a dividend yield that meets our criteria. So we're able to, you know, target that 3% total investment income return that's on our fund, plus another, you know, call it 3 to 5% appreciation on top of that for a total return of 7 to 9%, which is what we're targeting.